Tune in to the FinTech Files for exclusive interviews with FinTech executives and thought leaders. We will talk about how the industry will overcome the crisis that has marked the start of the decade, how it can be part of the solution, and how the financial world will evolve in the next decade. This is your host, George Alaferis from Arama.
For this episode, I had the chance to talk to MJ Lytle, CEO of Tabula Investment Management, an innovator in the fixed income ETF space. In this first part of our conversation, we'll discuss his career and why he decided to launch a new ETF provider to create the tools that fixed income investors have been missing. So thanks very much for your time, MJ. Welcome to the show.
Thank you very much. Good to be here.
And so we're 27th of May, and we're both confined. I think we can still call it confinement, right? It's a bit blurred. So can you just tell us how this lockdown affect you personally and professionally? How's it working for you?
Yeah, I mean, it's obviously been a pretty strange time. I think first and foremost, the disease. I've been very lucky. I haven't been sick. The friends and family that I've had that have been sick have had relatively mild cases and have come through it okay. And so, I haven't been through the stress that some people have, having people be very ill and dying and not being able to be near them. Personally, my personal life, it's an odd thing being confined because even though I have quite a comfortable circumstance, a nice garden, a wonderful partner, you're physically in the same place for much of every day, which means that you just start to feel a little claustrophobic, even though you have a reasonable amount of space around you, which is a weird combination. I also have the challenge that my children live in the United States. They go to university and upper school, and therefore I haven't been able to be close to them for several months, which is starting to get difficult. We have lots of calls, video calls and things like that, but nothing's quite the same as being in the same room with your children. Professionally, I think it's been a good time to take stock around assumptions about how businesses work. So, I've always been a fan of personal interaction, having people in the same space, creating teamwork, overlap, conversations. And I've always thought that physical proximity was important to that. Obviously, the lockdown has gotten in the way of that. So we've had to try and sort of recreate that feeling using technology. So we start every day with a call amongst the firm. I mean, the firm is only 20 people, so that makes it easier to have a conversation amongst all of us. We have a series of meetings throughout the day that we also tend to do on video calls. We, I think, try harder to communicate with each other. And then with clients, we've looked to see what's really possible, interacting by video and by phone to get things done. Because, as an asset management business, we have to constantly be having conversations with investors and potentially having them enter our funds. And traditionally, the rule of thumb was that you would start a conversation with clients using email or phone conversations, but you had to meet them physically before they would actually invest. And obviously, we're not meeting them physically. And so the question is, can you go to the final stage of having them invest without meeting them physically? And I think if we tried to do it without everybody being in the same situation, it might have been hard to convince people to change their behavior. But since everyone's forced to not travel, they've also been forced to try and get comfortable with strategies, do all their due diligence and so on the phone and on video. And that's incredibly efficient. The T&E budget for traveling to go see clients has gone to zero. The time from starting a conversation to making an investment has shortened. There used to be a lot of forced gaps when you would have a conversation with a client and the client would say, that's super interesting, but my next stage is I need you to come down and meet the team. And then you start to figure out when you go meet the team. And if you're going to visit the city, you'd have to go probably, if you're visiting one person, you visit 5. So then you had to build a schedule around that. And so you set it several weeks out in advance, plus you had to find a time that worked for that client. And inevitably you built in, 2-3 weeks of delay from when you said, this is interesting, to let's set the next conversation. Now you just say, okay, well, can you arrange people to get on a call tomorrow? The next day, all of a sudden, you're just stripping weeks out of the turnaround time. So I think we're learning things. Hopefully, some will stay. We've learned how to use electronic communication more effectively, sending emails, LinkedIn, and so on. And so I think there's some positive developments.
All right. Yeah. From what you're telling me, it seems like some of the steps in the due diligence process, in the selection process, will always have to be there. But it seems like the cultural aspects around it have evolved a lot, right? Both on your side and on the client side. And I guess some of it will stay.
Well, Italian clients, for example, deeply value having a coffee with you in order to really make sense of whether you're someone they can trust. And so the coffee, of which you had many, was kind of a key stepping point in the relationship. When you can't do that, you have to figure out what a virtual coffee looks like. And I think people are starting to realize what it was they were trying to get from those human interactions, and what they can get. They just have to triangulate their way to getting comfortable with who someone is, who their firm is, what they represent, how they do business. Are they trustworthy? All these sorts of things.
Mm-hmm. So I guess the overall budget across the city of entertainment and travel is even if when the things go back to normal, probably not gonna go back to its pre-crisis level, right?
Well, I think this is the challenge for the travel industry, right? Anywhere from the airplane companies to the airlines to the hotels to the taxis. If we stop moving around as much for business, and that's a big driver of travel expenses, how will they adjust accordingly, and how will they keep their businesses running? I think there's been a lot of concerns around how long, even if we had a bounce back, let's say this reopening that's going on in Europe over the next month or so kind of continues, and by July people are able to travel. How much will people want to travel? Will they have lost some of their appetite? Will the risk reward trade-off of, it's so nice to go to Barcelona versus getting in an airplane, going to an airport, being in tight confinement with a lot of different people, am I comfortable with that? So I think that what we've also learned is that governments can force certain rules, but it's actually humans who decide how they comply with them. And you can have humans follow the same guidelines even without having them officially in place if they just think that's better for me. And for the travel industry, when you think from 50 years ago, traveling was a huge deal, right? And not that many people traveled great distances. And there are many barriers to moving around. To today, where the average person is expecting to go on holiday at least once a year in a country other than their own, that has driven up an enormous industry around it. And, that also has implications for the environment that we've all been wrestling with. And we've kind of been saying, how do we hold on to this freedom, but also, cut CO2 emissions? Well, the answer is with our current technology, you don't. But I want my freedom, but I want to be able to go to, I want to be able to go to South America, and I want to hike the Andean Trail and so on. Okay, but there are trade-offs here. Now there's another, weight against traveling, which is just people's nervousness around the risks of traveling. And I think also people may have learned a little bit more about the pleasure available on their doorstep and in simple things. How it's not really about the stuff that you write in a Facebook post that everybody else is impressed by. That's great. A lot of the stuff is very personal and it's enjoyable, and it's just as important.
Hey, that's a great philosophy for our time. We could discuss a lot more about it, but let's talk about you and your career, and we're gonna get, of course, to Tabula. But first, how and why did you get into finance?
So it's funny. I probably got into finance because I didn't know anything about it. And it seemed kind of appealing as somebody who'd never experienced anything in the space. I mean, a lot of my friends, their fathers worked or mothers worked in finance. They had done internships and all these different things. I hadn't done any of that. When I did an internship, it was to earn some money. I was an electrician's assistant. I worked in ski resorts and stuff like that. So I'd say probably what got me into finance was a complete lack of understanding of what it was. Possibly if somebody had explained to me what it was, I wouldn't have done it. And when I arrived, my first job was with Morgan Stanley. I got lucky. I got an off-cycle analyst opportunity. Now, you know what the analyst programs are like getting into investment banks. It's a complete bun fight. You start with thousands of people. You end up with one getting a job, and it's completely impossible to get anything. I came in when they just were looking for one guy to do oil, gas, and chemical corporate finance. They needed one person. I showed up just when they needed him. I met the people in the team. We got along. The guy offered me the job on the spot. And then he said to me, oops, I wasn't supposed to offer you the job. I'm supposed to get approval from the people above. Can you give me a second? And so he went off and got approval and came back and said, okay, the job's yours. And as soon as I entered, I realized I was in a world I didn't understand. And there was always somebody that I was working with that knew 1,000 times more than I did. And that's what made it interesting to me, because, the very steep learning curve of constantly having challenges, constantly having new things, not understanding what they were, reading, asking, computing, trying to figure out how things worked. That's really what kept me fresh. And throughout, I spent 18 years at Morgan Stanley, and you'd say, wow, 18 years at an investment bank, didn't you get bored? Well, I did something different every 2-3 years. I moved all over the firm. I started in corporate finance. I went to capital markets. I moved into fixed income. I did sales, trading, electronic, like technology strategy, electronic trading, multi-asset class, structured products. I moved into equities before we set up, an ETF business, which became Source. I was constantly changing, and it was because I had such an appetite for these steep learning curves and to be doing something that I didn't understand. I think fundamentally, I always overestimated what people around me knew, which was good because it meant I kept pushing myself and I held myself to a very high standard on what I should know and what it seemed other people knew and I didn't know. So that's really what drove my finance career up until the point where, we created the Source, which is an ETF business that came out of Morgan Stanley and Goldman Sachs. We then got support from Bank of America, Merrill Lynch, JP Morgan, Nomura, and created basically a multi-bank asset manager, kind of similar to Lixor or DBX trackers, but not trapped within one bank. But we did it in a third-party asset manager, which had a certain degree of independence from those banks. And so therefore, we were really focused on what makes a good asset manager, what makes an interesting product offering, how do we make ourselves relevant to our clients. And in that, I basically discovered a way to bring all 18 years of experience to bear in the various parts of the business. So if I looked back, I'd never sold a fund, I'd never sold an ETF. I hadn't specifically packaged things like this, but I'd always recognized a value proposition, ways of delivering it to clients, and then how to get it into the right clients at the right time. So basically sales and marketing. You do the same thing across all the businesses. And I just took all these different experiences that I'd had with structured products and bonds and bond origination and setting up legal vehicles and working with companies on the corporate finance side and just brought it all to bear in a kind of like, how do you build a business? And I was very grateful for that. I mean, I call my time at Morgan Stanley my 18-year MBA because, you're doing the business, you're learning, but you're really, year to year, things are changing pretty significantly. And I always thought, trying to do an MBA, taking a business, which is really a doing thing, and turning it into an academic thing, that's a serious challenge. Whereas for me, it was about learning something new every day and then immediately putting it into practice. And the determinant of whether when you put it into practice it was useful was you sold something or you didn't. If you didn't sell something, it didn't work. And if you did sell something, it felt great. You could go on and try again. So there's a lot of immediate gratification from that form of learning.
Yeah, I definitely get it. Having been in finance myself for over a decade and then exiting it and coming back into it and really enjoying this intellectual challenge, intellectual curiosity that there is in the world of finance and constant innovation. So I'm with you there. Yes, I can see how it's not all bad. In fact, it can be quite a pleasant thing to do. So now let's talk about Tabula. And you said, you told us about everything you brought into your previous role at Source. So can you tell us now that you're the CEO and founder of Tabula? What made you launch the business and what is it about?
So, Tabula is an asset manager focused on fixed income, mainly in passive solutions for fixed income investors. And the reason why I got into the space was a couple of things. One was I felt in the ETF space, which is generally a passive space, although it's expanded from there, fixed income was seriously behind equity. So equity was a business where passive investing had become a big deal, 10, 20, 30 years ago. And it's evolved from, 30 years ago, but it was recognized quite a long time ago that it was more important what you were exposed to than how you were exposed. In other words, if you wanted to be exposed to automobiles, it was just important that you had a broad exposure to all automobile companies than exactly what weights you had to each individual automobile company. Because if all the automobile companies were going to jump forward 10 or 20%, you just need to be exposed to that jump. So that concept in asset allocation was accepted for equity exposure. It hadn't really been accepted for fixed income because the idea of fixed income was, but it's a really diverse asset class and it's much more important. The human being brings so many things to the table, and therefore, you can't really take effective passive exposure. You have to constantly be nuancing how you take the exposure. And therefore, the assets that have gone into fixed income versus equities in the ETF space have been significantly less. The fixed income asset class is double the size of the equity asset class, but it's about a third of the size of the equity asset class in terms of asset gathering in the ETF space. So I could see, looking at this a few years ago, that I'd spent time in the early 2010s raising money for fixed income ETFs and having ideas about how the asset class would transform, but it hadn't happened. Secondly, there was a very concentrated number of providers in fixed income. So unlike the equity space where there are dozens of different equity ETF providers, there are only 10 to a dozen proper providers in the fixed income ETF space, and therefore it was quite a concentrated market. Now, some people would say that was a challenge because they would say, well, that means everybody's very big, so how could you break in? But actually, I look at it the other way around. Many investors need multiple providers. Markets are wide. There are thousands of investors to talk to. If you're only competing against 10 to a dozen institutions, inevitably there are going to be pockets that are not left, not serviced. And so I saw that as an opportunity. And third, because of how early we were in the pacification of fixed income, there was a lot more product development that could make sense that hadn't been done in the fixed income. And even a new entrant could potentially add some really interesting products and exposures that other people, the largest providers, hadn't even touched. So from my perspective, delivering a passive fixed income asset manager mainly focused on the ETF wrapper seemed like a viable and exciting opportunity, whereas most other doors in the ETF space were pretty well closed.
All right. And who do you, so you're mostly focused, I guess, on the institutional space. Um, who are your typical clients, or what type of investors are you looking at?
Yeah, so we're focused on institutional, and everybody in the space is focused on institutional. So even BlackRock doesn't cover individuals. Right? Retail is left to retail institutions in the UK. That might be IFAs. In Germany, you've got lots of robo-advisors, private banks, and, Italy, insurance companies. Really covering individuals is a whole business proposition of itself, totally independent of the kind of exposure that you'd offer them. The legal hurdles of covering individuals, the risks. It's really not. It's a totally different business from covering institutions. So yes, we completely cover institutions. Institutions also represent 90% of the assets gathered in the ETF space. People will refer to retail assets, but what they're usually referring to is institutions who gather assets for retail investors. But the ultimate decision maker that the provider is facing is an institution. So who do we cover? We cover everything from pension, insurance, asset managers, banks, private banks, wealth managers, family offices across the whole of Europe. So we cover UK, Nordics, German-speaking, French-speaking, Italian-speaking. We have someone covering sovereign wealth funds. We have someone covering, large institutions that kind of fall through the gap because they're not specific to one location. We cover Middle East and Israel. We have relationships in Asia. I'd say the two things that we haven't really pursued at this point are South America and Africa, both of which are interesting for the future, but more challenging from an investment versus return perspective. It takes a lot more work to get a return from those geographies. But as you know, the UCITS fund is kind of the universal solution. It works in the vast majority of countries around the world, and can be passported all over Europe quite simply. So it kind of is, it opens the door to covering institutions in most of the world.
And looking specifically on how you present yourself and address the needs of those clients, how do you differentiate, for example, for another ETF provider, more established ETF provider, which also has a few fixed income ETFs? What does Tabula offer what does Tabula do differently or offer that's different? Is it the product? Is it the way you build the product?
So when you look at indexing and fixed income, there are fundamentally three big challenges to indexing fixed income. The first is that we talk about fixed income as an asset class, but it's actually a series of sub-asset classes. Each of those are very different from each other. And so you need to be quite specific what you want to deliver. So whether you're delivering investment grade, high yield, emerging markets, G7 government bonds, mortgage-backed securities, municipals, all these things, every single sub-asset class is different. And the approach that you would take to creating exposure in those sub-asset classes is going to be different. And you have to understand sub-asset class to create the right solution. Second, once you get into an asset class, there are a huge number of securities. So, they're about, last count, I saw about 9 million fixed income securities in existence. Each individual sub-asset class has hundreds of thousands of securities. So when you index a sub-asset class, you're not going to use all the securities. You're going to have to come up with some filter for choosing a very small number of the securities by number. And the third is that there's a very limited amount of data around fixed income securities. So, if you pick an individual bond and you want to get prices, it's very rare that bond will actually be traded on a daily basis. And so if you go back and you try and figure out, well, what's the right price for this bond? How do I get a clean price on a daily basis? That's, pretty difficult to do. So what I highlight to people is that the indexing of fixed income that's been done to date has been very much a kitchen sink approach, which is basically look at a space. Let's take, investment grade corporate bonds and try and grab as many bonds in the space as make your benchmark look credible from having taken a big enough slice that you must be well exposed. And this means that benchmarks tend to have thousands of bonds in them. And when you go to aggregate benchmarks, they may have tens of thousands of bonds in them. Now, this creates two challenges. One challenge is how do you deliver that exposure if these underlying assets are not necessarily liquid, easy to purchase, or easy to price? But secondly, what have you achieved by taking so many different bonds? Have you really achieved something for your client? Tabula's approach is to look at a space and to try and be a little bit more specific about what it is we're trying to deliver. So we basically identify factors, fixed income factors, which are what we think investors are trying to capture when they go into gaining exposure to that space. And then we deliver a purer exposure to that factor. So for example, when we did an investment grade corporate bond product, we didn't immediately assume that we needed thousands of bonds. We reckoned we could do it with fewer than 500. We thought it was probably pretty important to identify which bonds were truly liquid as opposed to which in theory should be liquid. We thought it was pretty important that those bonds qualified for things like the ECB bond buying program, because that's where some liquidity comes from, or a meaningful amount of liquidity. We also thought it was pretty important that your exposure to different issuers was equal weighted, because if you had an overwhelming exposure to a small number of issuers, that would create distortions, and it would also be less efficient. It would mean that you had exposures to much higher exposures to certain sectors than other sectors. So it's just a way of stepping back from what you're trying to deliver to clients and trying to go back to basics and say, what is it that people really want? What's already been delivered in the existing products and therefore kind of done? And let's deliver something that adds value in addition to the existing products. When I got into the equity ETF space more than about a dozen years ago, our approach was exactly the opposite. It would say, where are the assets? Let's do exactly what everybody else is doing. Let's just do it a little bit better, and let's compete with them head to head. And ultimately, that's going to mean chipping away at everything in order to be slightly better. And so we'll chip away at fees, and we'll increase liquidity, and we'll improve counterparty risk, and all of these things. And we'll win these assets on the margin. Frankly, in fixed income, I don't really think that is the opportunity. I think being slightly better at delivering the existing exposures just isn't that interesting. You want to look at it and you want to say, well, only a relatively small amount of money is managed passively in fixed income. Everybody else is managing it actively. What are the tools that they need to make this transition from active to passive? Not that we want to beat active managers, just that active managers generally are more efficient when they have good passive tools to execute their views. So we need to figure out what are the tools that are going to make this useful to them so the money moves across, and so that we're solving problems for people.
Yeah, and I saw you had an article about this with Tabula. What investors can get is a lot more, if we keep the same image, a lot more precise tools, and a lot more, if I understand you well, it's also more crafted with a fixed income expertise rather than applying, let's say, the general rules that we apply for indices. Is that a way to put it?
Yeah, I mean, if we want to follow the toolbox analogy, I think what I said at the time was it's like having a toolkit full of screwdrivers. Screwdriver is quite useful, but if you're trying to hammer something in or loosen a bolt or something, it won't do the job. And so, as a sort of amateur DIY guy, I know that oftentimes the speed at which I get a job done is down to whether I have the right tool in my toolbox. And if I start trying to use something to do something it's not intended to do, I either break it or I fail. So if I want to, when I build my toolkit, I make sure that I have an interesting mix of screwdrivers and spanners and Allen wrenches and adjustable wrenches and all sorts of things, because it's always the thing that I don't have that I end up needing. So I think it's the same thing when it comes to investing. You know, if you don't have a number of different tools at your disposal, either you'll find that you don't have the thing that you need, or you'll end up using what you have, but using it inappropriately. And so I think that our job as passive managers are to deliver a broad range of tools that deliver quite different outcomes in different market conditions. They give you exposure to spread in the credit space without exposure to interest rates. So fundamentally, a corporate bond has two components to it. One is exposure to where interest rates are in general, which is usually represented by government bonds, and then the risk-free rate. And then there's the component of what that individual company pays above the risk-free rate, because they are not as safe as the underlying government. Those are two very different investing decisions.
Thank you, MJ. This is the end of part 1 of our interview with MJ. Join us again as we're going to discuss the recent crisis together with MJ, what happened, and what investors in fixed income can learn from it.
Thanks for listening, and thank you to our guests who make this possible. Subscribe to never miss an episode. As this is a new broadcast, if you could give us a 5-star review on iTunes and your favorite podcast player, that would be great. Let's work together to accelerate fintech towards the 2030s.